Hi, it's Randy Herman with Keller Williams Realty, bringing you everything real estate. And today we're going to delve into another tool in the investor's arsenal for investing in real estate. And I have with me an expert, Ken Fitzpatrick. Ken, thank you so much for being here.
Thank you for having me.
But before we start, I just want to say that because we're going to be discussing laws and regulations that deal with financial matters, this is a disclaimer that you should check and do your own due diligence. And please call Kent or myself if you have any questions, and we can also lead you to other experts who can answer your questions in more detail. So, Kent, thanks for coming again.
Great.
Really appreciate it. Oh, why don't you tell us a little bit about yourself and your company?
Sure, thank you very much. So I'm the Managing Director of Asset Strategy Advisors. We're based in Natick, Massachusetts. I've been in the business for 30 years. We're an SEC registered investment advisory firm. I'm also the Managing Director of Charles River Financial Group, and we also have an affiliation with a broker-dealer, Concord Investment Services.
Right. And what's the difference between the two companies?
One is a fee-based, fee-only investment advisory firm. The other is affiliated with a broker-dealer, and we also have insurance professionals in our organization too.
Okay, and what does your companies do? I mean, exactly.
So we do fiduciary consulting for corporate retirement plans, and we do wealth management for individuals. And I think that's really what kind of led us into this area of the law.
Right. So I had the pleasure of attending one of your seminars on the topic today, which is opportunity zones. And I was wondering, since you seem to be a master at this, and you had such experts on your panel up there, if you could explain to us what is an opportunity zone.
I'd be happy to. So this is brand new law. So this, to give you a little bit of a background, this was created out of the Tax Cuts and Jobs Act of 2017. It was actually originally started in a white paper from 2015 from the Economic Innovation Group, which was funded and started by the founder of Napster. And he was looking for a way to have the taxes from capital gains. He was also the first president of Facebook, so he had a lot of tax and capital gains to see if there was some way of doing good for society in focusing predominantly on areas of economic
by using his
distress.
profits.
By using his profits.
Right.
So rather than making a gift,
Right.
how can I invest and make an impact on that community?
Okay.
And so it was really, when it was picked up by a Republican senator from South Carolina, Tim Scott, as well as a Democratic senator, Cory Booker from New Jersey,
Right.
it was a bipartisan bill that became law when they signed it, part of the Tax Cuts Jobs Act.
Okay, and what does this law do?
So it has created over 8,700 qualified opportunity zones across the United States. Mm-hmm. And really what that is, it is areas of economic distress, either wages or job growth that are below national averages. And so it's a way of stimulating investment in those communities by tax incentives. And so each governor had the ability to define up to 25% of what's called the LICs, or low-income communities,
Right.
within their footprint, as well as the District of Columbia and 5 U.S. possessions. So those went hard in terms of defining which of those 25% areas in June of last year. So
Right.
this is still, again, fertile ground, and there's still a lot of uncertainty right now.
So I know that there are maps that you can see, and I've put up on the slide here
Yes, yeah.
some different websites that you can go to. I know, like, for example, Baker Tilly, you can actually put in the address if you
Yes,
want
yeah.
and see it, but there are larger maps. And I think one of these are yours, the
Yeah, we're trying to create a resource center for both funds, which we'll talk about in a minute. A good one is the EIG.org, that is the Economic Innovation Group, and you can put any address in the country. And you'd be surprised, because it's not just these low-income communities. It's up to 5% of adjacent communities could also be designated within these O zones. So you may be surprised to find places like Napa Valley that are in an opportunity zone, or a good chunk of Scottsdale, Arizona, or waterfront property in Falmouth, Massachusetts.
Well, I remember at your seminar there was the mayor or one of the government officials from Framingham who said that there's 2 zones in Framingham as
Exactly,
well. Yeah.
exactly.
So what exactly is an opportunity zone?
So I want to define two different things: an opportunity zone,
Right.
or I'll call it a QOZ, versus an opportunity fund, or QOF.
Okay.
So an opportunity zone are these areas that we define that are on these maps of low-income communities.
Okay, a geographic area.
Geographic areas, correct. And a qualified opportunity fund, or QOF, is basically a corporation or partnership that is investing in both businesses or property in those particular zones.
Okay, and how do you get into one of these funds?
Into a qualified opportunity fund?
Yes.
So there's really two ways, and we'll refer to it as either active or passive. So either I want to take, and we should talk about the tax incentives here. I want to take a gain that I've created, and I want to defer. I want to reduce, and I want to eliminate that gain through this investing in an opportunity fund.
Not the gain, but the tax on the gain, right?
The tax on the gain, correct.
Okay.
Correct. Do you want me to describe that?
Yeah, please.
Yeah. So really, the three benefits from an investor standpoint are that deferral, the reduction, and the ultimate elimination of tax. So the rules state that if I create any capital gain from an unrelated party, meaning I can't sell my property to trigger a gain to a relative.
Right.
But
the capital gain doesn't have to be just in real estate, right?
That's correct, and that's actually a really good point, because under that same Tax Cuts and Jobs Act that created the opportunity zones, it also took away in the 1031 exchange the ability to do anything other than real property. So if I had an art collection, I can no longer 1031 or exchange that.
Right.
So now the opportunity fund allows me to take any capital gain. So think about it. I sell my business. I sell a low basis stock. I sell my Bitcoin collection, my art collection. All of those are creating a capital gain.
Absolutely.
So what I can do is if I carve out the gain, I can put my basis, my original principal, in my pocket. I carve out the gain, and if I reinvest that in a qualified opportunity fund within 180 days of when I created that gain,
Right.
then I will get to defer paying any tax on that gain until either I sell that fund or the end of 2026. So I have a 7-year window before I pay any gain. So I have all 7 years of
So you're
compound.
deferring, the first step is to defer the capital gains.
That's correct.
That you're putting into the fund.
That's correct. So the money
Tax on the fund, yeah.
money I would have paid to Uncle Sam is staying in my account and compounding and growing over that up to 7-year period.
Right.
Okay.
Okay, so how does this fund determine where and how they're going to invest that money, and how long do they have to invest that money?
Good question. So talking about reduction, and then I'll get back to where they invest. So we talked about I get to defer for up to 7 years.
Right.
Now, if I invest in that fund for up to 5 years, I get a 10% reduction of the taxes that are due. It's actually, I'm increasing the basis in terms of what the tax I owe. And if I hold it for an additional 2 years, or a total of 7 years,
Right.
then I get an additional 5% reduction, or a total of 15.
Wonderful.
So let's run through a quick example. So let's say I sell a business for $1.5 million, and I have a $500,000 basis.
Right.
So I've created a $1 million capital gain. So normally I'd have to pay 20% federal long-term capital gains rate. Massachusetts is 5.2. I may also be subject to other net investment income tax or
Right.
depreciation recapture. So all of those taxes I mentioned, at least on the federal level,
Right.
I can take that $1 million, reinvest it in a qualified opportunity fund, defer those taxes, and also reduce the taxes if I'm holding it for 7 years. So I'm really going to pay
Right.
tax on 85% of that amount.
Right. Now, there's a third step to that, right?
Yeah, probably the most powerful of the steps. So we talked about 5, we talked about 7. Now, I will have to pay my tax at the end of 2026, actually April of the following 2027.
But a reduced tax.
On a reduced amount, and I had all the benefits of the compounding growth all those periods of years.
Right.
So I'll pay my tax at that point, but that original investment, so my $1 million example of tax, if that has now grown to say $1.5 million, then if I'm in that investment for 10 years, I pay no tax forever on that new investment.
On the new investment,
On the new investment, correct.
meaning not the original investment that you put in.
Yeah, because at that point, I've
You've
already sold my
paid it
business, and I'm going to pay the reduced tax and get the benefits
In
of tax deferral.
2026,
But it's now that
7,
new investment
right.
that I've invested in one of these funds, investing in businesses or property in these
Right,
zones,
right.
that I'm going to get the benefit.
Right. I remember somebody on your panel was saying that hotels expect at least a 5-fold increase in terms of their appreciation from their investments. So that would be a lot of capital gains.
It would, and what I would tell your audience is a good tax policy does not equal good investment. So you really have to do your due diligence. And there's a number of different asset classes. So hospitality or hotels could be one example, multifamily is another, student housing would be another example, or businesses within those zones. Now, one thing the code does say is that you can't invest in what they refer to as sin businesses. So kind of some strange ones.
All the best ones.
Well, golf courses are in there, and
as a sin business or not?
Yeah. So golf courses, gambling, massage parlors, liquor stores.
Right.
But where there's a gray area is actually with cannabis, because it's illegal at the federal level, but it's legal at the state level.
Okay.
So one other thing I wanted to mention is that the regs became law January 1st of 2018. It was June when all these zones were defined.
Right.
So there was a hearing on October of last year, October of 2018, to kind of put to rest some questions about different provisions.
So it's a work in progress.
It is, and so what happened was, some of the questions were addressed and others weren't, and so they were supposed to have a follow-up hearing just this past January. The government was closed, so that was postponed until February 14th, Valentine's Day, just a little over a month ago.
Right.
So the final proposed regulations are supposed to be released literally within the next week or two. So some of this is still not exactly defined yet, but these are the basics of the law.
I see. And what we're talking about here is really just the federal tax. It doesn't have to do with the state tax?
That's an excellent question, because of all 50 states, states are either conforming or non-conforming, meaning that they're going to conform to the federal exemption. Unfortunately, Massachusetts happens to be non-conforming for individual state tax. It is conforming for corporate tax.
Right.
So if I create a capital gain in my corporate entity, then that's exempt. But I'm going to pay 5.2% for state capital gains, not to be confused with the 5.1% state income tax rate.
Okay. So maybe we can go over some, it's a bit like threading a needle, my understanding, or that my impression is about this law, because there's a lot of rules and regs that go along with it, right? Such as the 180-day period you have to put your money from when you get the capital gains till when you put it into an opportunity fund. Yeah.
Well, and we started the conversation talking about active or passive, and I think I want to kind of clarify that a little bit more.
Please.
So you have the 180 days to take your gain and invest it in a qualified opportunity fund.
Right.
Now, the fund itself, this is where we can kind of split between active or passive. So I can either create my own fund, which I would say that's active, where I have to follow all the rules, the timing.
How difficult is it to do that?
Well, don't do it alone. You better have good counsel, both legal and tax counsel, because there's a lot to it. So there is a self-certification form.
Let me just ask you: do you have people on your team who can do that? You can recommend?
We don't practice law, or we're not CPAs, but we have a vast network of folks that are expert in this space.
Okay, good to know.
Yeah.
Okay, so to form your own fund, then you're saying is a bit tricky to do.
It is a bit tricky, and there's just to name a few of the rules or regulations. I'm not sure if you have it on here, but you have to invest at least 90%, into a property that's in these zones. If it's a direct investment,
meaning
or a single
the fund
asset,
has to invest.
Correct.
Yeah.
Correct.
Okay.
So just because an edge of the property is in a zone, and the rest of the, that's not going to fly.
Right.
The other thing is you have to substantially improve the property. So let's say I buy a property for $1.5 million, and $500,000 is the building, and $1 million is the land.
Right.
Well, I can't. The land isn't going to change.
So the land is exempt.
Land is exempt. So in that example, I would have to substantially improve. I'd have to improve by at least the basis of my building.
The other $500,000.
Yes.
Yeah.
So if I have a $500,000, I'd have to put at least another $500,000 in. I also have 30 months.
Well, can I ask what happens if you don't put in exactly a $500,000?
There's penalties that if you're non-conforming.
Okay.
So and there also is penalties for not executing, so you have 30 months to put your capital to work.
Okay.
Because, again, the whole idea is we want to get jobs and businesses
But
flourishing in
just
these
30
areas.
months? I mean, these projects can take years and years.
Yeah, see, that's the problem. It's very, very tight timeline. So a lot of these projects, they're shovel ready. They have to be shovel ready projects because you know what it's like in real estate for
Absolutely.
permitting and approvals.
Yeah.
So you really have to have your ducks in line and know what you're doing if you're going to create your own fund.
Okay. And then can you invest, I know, of course, we're talking about real estate, but can you invest in businesses in these qualified zones?
Absolutely,
Opportunity
yeah.
zones?
And so, again, there's certain qualifications for the business, and really, I think your slide has it here, a two-tier. So if I'm investing in a business that happens to have an operation in a zone,
Right.
then the fund itself has to invest at least 63% in that, as opposed to 90% if it's a direct piece of property.
I see.
So there's some nuances between business property versus businesses.
Right. And then again, you have to pay your capital gains by when?
So you're able to defer the gains until the end of 2026 on
The
your
original
gain.
Okay.
I'm going to pay my reduced tax, 85% of what I would have been taxed on previously.
Right.
So I'll pay that in 2026.
Right.
But then the new investment, I have actually up until December of 2047 to exercise and sell that qualified opportunity fund.
Oh, that's a nice long time.
Well, I think the idea behind it was they didn't want to force people after 10 years to forcibly sell
Right.
the fund. Maybe someone wants to continue.
Yeah, like
but-
so many people depreciate a building and then they sell it off because
Yeah.
they have no more tax.
Yeah, and there's
incentive.
really no pound of flesh that the IRS wants, is going to be able to collect after that. But the way they wrote the code, you're protected through the end of 2047.
Okay. Any other regs that come to mind?
Oh yeah, well, there's probably several. We're giving the tops of the trees.
Yeah, we
here.
only have another 15 minutes.
Yeah. I would like to talk about kind of the similarities or differences with 1031 exchanges, because I'm sure you've talked about that on your show. in the
Absolutely. I
past,
think
too.
I put a slide here. Yep.
Yeah.
And I just was putting the 1031 issues here, but please.
Yeah, so I think it's worth describing. So as we talked about before, 1031 as of the 1st of 2018, it now is only real property, so it's no longer personal
Right.
property.
And just to let you know, I did interview John Starling from
Sure.
Yeah,
Yeah.
Northern Trust, and he explained all about 1031s to us.
Oh, fantastic.
Yeah.
So I'll kind of maybe parallel some of those.
All right.
So it's just real property now. That's where the law has changed. A qualified opportunity fund can be any capital gain. So it doesn't have to be just real estate, any capital gain.
Boy, that's a big plus.
It is, and I feel sorry for people that have collectibles, because before they'd have the advantage for personal property to be able to exchange that, like an art collection. Now they can't. So
Right.
this is a kind of a good replacement for that.
Right.
The other thing is you have 45 days to identify a replacement
In a
property
1031.
In a 1031.
Right.
And then you have 180 days in total from the beginning of your sale of the property to close on it.
Right.
You have a similar 180 days here in a qualified opportunity fund.
Okay.
You don't need an intermediary, a qualified intermediary, like you do in a 1031.
Well, that makes it simpler.
Yeah,
Yeah.
so that there's no complexity there.
Right.
And then a few other things, the 1031s, as you've said on your board here, don't have the 5 or 7 year step up. A very big difference is if I died in the middle of doing an exchange in a 1031,
Right.
my heirs will get a full step up in basis.
Yep.
That's not true in the qualified opportunity fund. So
Oh.
there is no step up in basis.
All of a sudden you have to sell, or?
You're yes.
out of it?
Yeah, so it depends upon if I died before the 5 or the 7 years, that's going to.
You don't get the benefit.
My family, my heirs would still have to pay the tax.
Okay. In terms of other opportunities that these funds present, I mean, obviously to the community, it's a great boon because there's investment money coming in. But how does one judge, whether it's a good fund or not, or which fund to invest in?
Well, that's a great that's the $10,000 question, I guess, as they say. Right now,
I mean, is that why someone would come to you?
Oh,
Do you know
absolutely.
about these-
Because again, as I said before, buyer beware. There's good tax policy does not make for a good investment. So you have to do your homework. You have to look at the nuance of these things.
Right.
And really, because this is brand new law, These projects are brand new too. So you really have to look at the management, the track record, the history of who's putting together the fund. And you have to be careful. You don't want two guys in a pickup truck and because they happen to own a piece of land in an opportunity zone.
Right.
You want to look at seasoned, established, well-heeled management and history and track record.
Right.
You also want to look at some of the competing factors. What's the development cost for the property? What's the anticipated rates of return? A lot of the institutional funds will have either what's called a PPM or private placement memorandum, where you can look at all the assumptions, all the facts, all the legal ease to it.
Right.
Not every qualified opportunity fund is formed for accredited investors, and I'll explain that. Some of them can be structured as a REIT. So what a qualified investor is someone that has a net worth of at least $1 million,
Right.
or has made $200,000 a year for each of the last 2 years as an individual,
Right.
or $300,000 as a couple. So if I don't meet those qualifications, that may preclude me from investing in some of these qualified opportunity funds. Not all.
Is this whole law and code, IRS code, is it really only for rich people?
Not necessarily, because a lot of the minimums for these can be as low as, say, 25,000. I've seen them, for gains.
Right.
But because of the illiquidity nature of it, that's why I think it has to be an astute investor. So it's not liquid like a mutual fund.
Right.
So
you talked about REITs and the way are these opportunity funds like a REIT, or do they incorporate REITs? Or
no, so it's a different legal tax structure. So most of them are set up as corporations or partnerships, but they can be registered investment companies or REITs in terms of their structure.
Okay. All right. Great. Terrific. So the benefits, once again, for an investor of investing, the capital gains are?
Well, it's really the number one, deferment of the tax that would otherwise be due.
Right.
Number two, it's the reduction of the tax by upwards of 15%.
Right.
And number three, it's the elimination of tax on that new investment.
Right. So that's the financial benefits. I imagine the others are you're helping the community.
Absolutely.
You could be active or passive involved in these things.
Correct. And let's say, I have a gain, I have a low basis stock, or I had stock options, and I know if I sell it, I'm going to get clobbered in taxes. Well, maybe from a diversification standpoint, maybe I'm overweight in equities, and I'd like to diversify, but it's really the tax tail wagging the dog.
Right.
So this may be a way that I can exercise, sell some stock, reinvest my portfolio, and now pick up private real estate as maybe an uncorrelated asset class within my portfolio.
Right. So because there is a time limit on when you have to sell or pay your capital gains, and then also sell, is it too late to get involved in this, or is this just beginning?
This is just at the beginning, and I know there's upwards of about 100 opportunity funds that have been
100 separate funds.
100 separate funds representing about 25 billion of capital investment into these economically distressed areas. So
Right.
it's ultimately it's a great thing, but again, they're all over the map. I mean, I've seen businesses
Meaning all over the country?
Well, all over the country, and the focus of the fund and,
and
some of the history of the background. I saw one that was a portable lettuce farm that was using containers that were parking them on these O-zones. So if you want to invest in this business, probably a very good business, which is a little bit different than if it was a multifamily, or apartment complex, in a more gentrified area of one of these zones.
So another question, are all these zones in just urban areas?
No,
or rural?
rural as well, absolutely.
And how, can they be used, for example, for venture startups if they need land, such as a marijuana farm? Or
They can, and it's a gray example because of the federal versus state example.
First one that comes to mind.
Yeah. Well, because that's one with extreme capital gains, so it's probably a good example. So I think within the next 2 weeks, a lot of the clarity that hasn't been there should be defined. At least that's what the community is hoping.
I see. So have any of your clients yet invested in opportunity funds?
They have, because I think some of the outstanding questions don't apply to every client. A lot of the outstanding questions have to do if I want to invest in a opportunities, a business in an opportunity zone. So if I'm looking to invest in a property, let's say you use the example for a hotel, you know, the outstanding questions aren't as applicable to land development versus if I'm investing in a business.
So the business question, the regs are still open?
They are. There's actually a number of questions. You know, the word substantially all has been referenced throughout, you know, the regulation, and they want kind of clarity. What does that mean exactly?
I remember at your seminar they were talking about, well, what happens if a business does most of its business overseas or has employees around the world? Or
it's a great example because I could have, you know, 4, 5, 10 employees in my business in my opportunity zone, but if I have, you know, online sales, you know, what's the regulation on that? So there are some of these gray areas still.
I see. Great. So are there any other considerations that you really need to you know, pay attention to in terms of getting involved in this sort of?
Yeah, so I think again, it's whether or not maybe you're in the real estate business and you want to pursue creating, you know, your own fund, which there's a lot of complexities and,
right.
and costs.
And actually, I heard a woman just the night before your seminar who was talking about a fund she had created in New Hampshire. And what had happened and how she had to bring in all the community so she could get buy-in and they could help her. And,
yeah. Well, and even the example you gave earlier, the gentleman that stood up from Framingham Community Development, he was embracing saying, any developers, we're ready for business. And I think a lot of it is having the government or municipalities or whatnot embrace that so they streamline the approval process, because with that 30-month requirement, that could really hold you up.
Right.
So that's an important step.
Right. Is there any way that they extend that time period, or that's a hard and fast
It's a
deadline?
hard and fast. And I think that was one of the during the comment period that they were asking for some relief to that.
And then how do you judge or vet experts like a CPA or an attorney or yourself, for that matter, who are involved in these?
You know, I think a lot of them are holding themselves out because they've done they've read the regs, they've done the due diligence, and I mean, even something as simple I brought along. You know, someone said, well, if I want to defer a gain, how do I do that? How do I'm going to be filing my taxes, you know, come April.
Right.
So this just came out in October, Form 8949. So there's a lot of misconceptions and bad information. So I think you really got to do your homework and understand, you know, who knows and who's expert in this area and who's not.
Okay. And in terms of due diligence, what can be done? I mean, someone asked this investor the same question. He says, well, what did you ask? You know, how do you go? She said, you just ask as detailed questions as you can, and one question leads to another.
You really do. Because unfortunately, you know, if I was to evaluate a small cap mutual fund, I could go into Morningstar and I could, you know, look at all kinds of, you know, analytics and software and so forth. This is brand new space. So there are some databases available of different opportunity funds, but you really got to dig in.
And as you had said, I would be most concerned about just making sure that the fund could execute on the improvements that have to be done within 30 months.
Yeah, and meeting the timing requirements.
Yeah, exactly.
Yeah.
That would be really tough. Yeah. So we're down to about a minute and a half. Is there anything that you want to add here, or that you can tell us that would help us, or maybe you could just give your information in terms of how people can contact you? And again, as a disclaimer, I say, please call Kent, and he can explain it all to you.
Yeah, I would say just, you know, this is an emerging area,
right.
And you got to do your homework, and you know, your accountant or CPA may not be familiar with it because it's brand new. So get educated about it. We're trying to put together a resource website with our ozoneshq.com.
Right.
There's a number of, I think there's 500,000 or 1.5 million if you Google search. You know, there's a lot out there right now. But our office we're based in Natick. This is an area that we're dedicated and focused in. Our phone number and email are there, so I'd be happy to speak to anyone if they need help.
Terrific. Well, I have to tell you that not a lot of realtors, I mean, I know there were some commercial realtors at your event, but there aren't a lot of realtors, at least in my office yet, who know about this.
Yeah, and we've been trying to educate
Yeah.
a lot of folks. That's why we did the event the other day.
Yeah, and it was terrific,
Yeah,
actually.
great.
Yeah.
Thank you.
So I can't thank you enough. This has been very
Yeah,
informative.
thank you very much.
Yeah, and hopefully you'll get calls about this. I'll certainly steer my people towards you.
Yeah, fantastic. Well, thank
Yeah.
you for having us.
Yeah, okay, thank you.
Bye now.